After years of trying to combat the pandemic's influences by inflating its balance sheet, which is approximately $9 trillion, the U.S. central bank changed its tune in early 2022. Wall Street is predicting a 2023 recession. What's driving the recent string of downtrodden economic forecasts? What can we do about it? And what are the things that banks are keeping from us? Stay tuned, as we will be unveiling everything in today's video. Hey folks, welcome to Business Bro. If you are new here, you must know that we are giving away 1,000 Dogecoin to our random subscribers. All you need to do is like the video, subscribe, and comment on your favorite crypto coin in the comments section. Good luck! With that being said, let's dive into the video. Number 1. Rising inflation. After more than tripling its balance sheet since March 2020, the Fed has decided to begin shrinking it, with some estimates estimating that it might soon shed up to $95 billion in assets per month. According to Reuters, the macroeconomic outlook is worsening fast and might lead to a recession in the world's largest economy, citing a note from Bank of America strategists. Reasons for the US dollar's decrease in the global forex reserve. The reserve issuer's public debt and reserve shares have a high negative association, according to the IMF research paper. This also corresponds to the reality that US public debt has been rising for 2 decades, while the dollar's share in the market has been declining. From 1776 to 1981, the United States accumulated a $1 trillion debt over a period of 205 years. However, over the next 40 years, the U.S. debt increased by 30 times to $30.36 trillion. According to the IMF, global forex surged to a record $12.83 trillion at the end of third quarter 21, while the U.S. dollar's share of global forex fell to a 25-year low of 58.9% at the end of 2020 and rose to 59.2% at the end of Q3 2021. This means that the dollar's declining desirability is largely due to the United States' expanding public debt. Number 2. Will the US dollar lose its reserve status? According to a recent IMF report, the share of the US dollar, or USD, in central bank treasuries around the world is decreasing. According to the report, the other big four currencies are not compensating for the loss of the dollar's market share. Rather, central banks are diversifying their currency holdings. The US dollar, the pound sterling, the Japanese yen, and the euro are the big four currencies. In 1999, they accounted for 98% of the IMF's currency composition of official foreign exchange reserves, or COFR. But by 2021, that figure had dropped to 92%. The IMF COFR of other currencies climbed from about 0 to 8% within the same time period. What additional currencies do central banks have on hand? Non-traditional reserve currency holdings have risen from roughly $30 billion in 1999 to around $1.2 trillion by 2021. According to the IMF's Coordinated Portfolio Investment Survey, global central banks owned $1,070 billion, or $1.07 trillion, in non-traditional currencies, such as currencies other than the Big Four, at the end of 2020. 71% of non-traditional currency reserves were kept in the Australian dollar, Canadian dollar, Chinese yuan, and Swiss franc. 3 European currencies, the Swedish krona, Norwegian krone, and Danish krone, and 4 Asian currencies, the Korean won, Singapore dollar, New Zealand dollar, and Hong Kong dollar, make up the remaining 29%. According to the IMF, the Chinese yuan accounts for 25% of non-traditional currency held by central banks worldwide, with a value of $272 billion. The reserves of the Canadian dollar are anticipated to be $247 billion, accounting for 23% of the non-traditional currency portfolio, followed by reserves of the Australian dollar, which are estimated to be $217 billion, accounting for 20% of the portfolio. According to the IMF, active diversifiers are nations with more than 5% of their foreign exchange reserves denominated in renminbi and non-SDR currencies. The IMF designated 46 countries as active diversifiers by the end of 2020. Number 3. Invest in assets. While it is evident that de-dollarization is already underway, the speed with which it will occur and the forces that will dominate global banking as a result will become clearer as time goes on. When the United States loses its standing as the world's reserve currency, hyperinflation is a distinct possibility. Let's hope that doesn't happen in the near future. This may make you believe that keeping cash is a terrible idea. Although it may appear that your dollars may soon be worthless, keep in mind that these changes do not occur immediately. Cash's purchasing power is diminished by inflation. Cash rapidly loses value as a result of this, as well as the poor yield on cash holdings. It's worth more now than it will be in the future due to inflation and other variables. That's why having too much of it on hand might be detrimental. Allowing cash to stay idle deprives you of the opportunity to earn a higher return if you invest it. Number 4. Crypto boom poses new challenges to financial stability. Bitcoin's price has been steadily increasing in recent weeks. But what's fueling this growth? While annual inflation is on average 2%, current stimulus expenditure is on track to significantly raise inflation and erode the purchasing power of the dollar. The U.S. economy has gained about $2.4 trillion as a result of recent stimulus initiatives. Many people are concerned about the dollar's purchasing power depreciating and rising inflation. To protect themselves from growing inflation, many people have abandoned the dollar in favor of assets that have traditionally held or even increased in value. People typically change their dollars into assets that are scarce or less volatile in general to escape inflation or volatile markets. Precious metals, stocks in low volatility sectors, and, more recently, Bitcoin are examples of these safe haven assets. Bitcoin's status as a safe haven asset is growing. In today's societal and economic environment, there is a growing incentive to store less cash and be hedged against extreme market moves. Recently, publicly traded firms have been converting cash in their treasuries to Bitcoin as a more reliable store of value. Number 5. Stay focused on your financial goal. Many people will feel compelled to put their long-term savings goals, such as saving for retirement, on wait in order to purchase the goods they require in this difficult period of rising costs. However, putting such efforts on hold will cost you a valuable resource that you won't be able to replace: time. Compound interest is most effective when time is taken into account. Inflation will not endure forever, as history has proven, and the essential principles of personal finance will always hold true. Live on less than you make, save, and have an emergency fund. These concepts might help you plan ahead of time to weather the inflation storm. With this, we have come to an end. We hope this session was informative. Do let us know in the comments section below. Subscribe for more content just like this one and share it with your friends. Also, don't forget to smash that like button and also press the bell icon to get notified about our new videos. Until then, fellas.